The challenge with AI is everybody has access to it. You're catching me when I'm thinking venture is just a hard business, a hard place to make money. Every 3 to 5 years, the industry, both startup and founder, just totally changes. And I think we've just moved into a much more transactional world. You want optionality. The startup game is so hard that if you raise too much too early, you actually cut off options. And the whole name of the game is being able to stay in the game long enough and maintain as many options.
As we sit here today, and it's easier than ever to start a company and harder than ever to break out, you need the people doing the things that don't scale to help you break out.
I look for founders that are able to have their own channel, tell their own stories. To your point, a lot of this is, can you rise above the noise? Yeah. And I think good founders are able to tell a story. And this is the point. The capital isn't what allows you to do it. Being a good storyteller does.
Yeah. As we sit here today, which job has gotten harder?
First of all,
hey climbers, welcome back to this episode of Climb by VSC. My guest today is a longtime friend, Micah Rosenbloom, who is a serial founder turned investor at Founder Collective, one of the most disciplined seed funds in our industry. Micah and his partners love investing in founders in weird and wonderful categories. They love staying close to founders, staying honest about what it takes to be an early stage investor today. Micah's portfolio includes companies like Talos, Verkada, and Lovevery. And he is focused on capital efficiency, founder fit, and staying close with founders through the messy middle. If there's a Mount Rushmore of firms that have influenced how I think about early stage investing, Founder Collective is certainly on it. So this is a real pleasure for me, Micah.
Thanks.
Thank you so
That's
much
high praise. Thanks for having me on here.
Man, we've gotten know each other over many years. We were just talking about off mic. We have met 10 years ago now, but you have.
But it only feels like 8, just for the record.
Exactly.
It doesn't feel like a full 10.
COVID warps everybody's
exactly.
sense of time frame. What I was kind of reflecting on is you have been a serial founder. You've now been investing with Founder Collective for about 15 years. As we sit here today, which job has gotten harder? And why has it gotten harder?
Oh man, that's a tough one. Just to step back, I feel like every 3 to 5 years, the industry, both startup and founder, just totally changes. Yeah. The game that it was in 1998 when I started handshake.com was just so different. There were so few VCs. It was, we literally stayed in the conference room until we worked out a term sheet together. Yeah. Imagine that. I don't want to say it was like a used car sale, but it was just it was a very IRL experience. And then, after that, I went to business school and I came out, and it was sort of like the beginning of seed and that stuff. And then I did another startup, and that was deep tech, and that was totally different. And also then I was on the East Coast. So I think each of these periods, venture has totally changed, even in the last 3 years, I think. Mm-hmm. It is a proper business. I mean, you feel this, with lots of marketing and institutionalization of capital and big teams. Venture was behind a velvet rope, I feel like, for most of my career. And now it's super accessible, which I think is a good thing. But I feel like it's a business. I feel like in many ways it feels like an operator in some ways. We're building a firm. We think about competition. We think about marketing and positioning more, almost sometimes too much, where I'm like, oh yeah, our job is to invest in great companies and help those companies thrive. There's a part of me that thinks the grass is always greener, and I miss the operating days. Yeah. It would be, if you put me on Truth Serum and you said you could go run an AI company that was in a really cool space, I think I'd be quite excited to do that. But we were talking about this. I think in the short term it seems easier, but I still think it's really hard to build. And when things get tough, they're just hard. And the ups and downs, the peaks and valleys are much greater operating than in venture. Mm-hmm. But at the moment, you're catching me when I'm thinking venture is just a hard business, a hard place to make money. I love what we do. I feel grateful to do it every day. But I think it's gotten a lot harder than it was 5 to 10 years, certainly than when Founder Collective started 15 years ago.
Well, let's double click on that.
Yeah.
What specifically about this current moment and where you sit at the kind of seed stage with the fund size that you guys have, what specifically has made it harder? I think
the same noise we feel as investors in AI or in some of these categories where there's lots of companies, you're like, how are these all different? I think entrepreneurs feel that about VCs. There's lots of VCs, they're all on Twitter and LinkedIn, and they, there's some good ones that have podcasts, but there are a lot of podcasts. How do I know? So it's just so noisy. It's very hard to rise above that noise. And I think there was a moment in time where there were a handful of firms. I'd like to think we were one of them, where on the East Coast or on the West Coast, we were like, you got to go see those guys. Yeah. And even if the valuation's a little different, or, if you can get their capital and get their support, they're going to make a difference. And I think we've just moved into a much more transactional world.
Yeah.
And I think that just makes the business harder because we're not transactional people. Like, I actually really enjoy working with founders. That's like what I get my substance for, my energy from. And when it becomes, hey, I know we met on Tuesday, but let me know by Friday, and which VC are you again? And it sort of feels like day trading. It kind of loses all the stuff I love about it, which so that may be as much about it's harder, but it's also, you know, I don't enjoy that part of the business. I much more enjoy building authentic relationships over years or decades. I think we've done a good job of that, but you know, that's harder in a much more compressed, you know, high velocity, you know, market that we're in right now.
I think it comes back to what people optimize for and in what part of the market we are that they're optimizing for it.
Yeah.
Right? And you know, right now, again, this is maybe raw and structured thought, so give me a little bit of rope here. But right now we're in this, you know, window of capital abundance, and, you know, people are writing rounds again, and especially AI rounds. It feels like sky's the limit on post-money valuation.
Yeah.
Uncapped notes are back in vogue. And to me, as you know, now I've been investing in startups a little over a decade. You know, you've been longer than that. Whenever you start to see some of those behaviors and patterns come back, you know where you are in the market. And I think back to like 22, 23, even a couple of years ago, or you know, maybe even like 16, 17, 18, founders prioritize partnership. They prioritize folks that could open doors for them, or, you know, help them with hiring. We're not in that part of the market. And so what I'm trying to interrogate a little bit is like, is that just gone now because venture has professionalized in a way? We've become quasi Wall Street? Or is it that we're just in a very frothy time?
I have a few thoughts, and I think it's a little bit of, but before I say that, I put an uncapped note on the table over there for the podcast. So I'm hoping by the end, I mean, the real reason I'm here is to invest in the podcast at, you know, 20% discount, uncapped.
Okay.
Done. I think we have a deal. The thing I've been saying to the team, and as we've looked at the data, and as I wear my operating hat, we have a specific product, and we have a specific ICP. And it's not everybody. ICP being, you know, a specific customer profile, an ideal customer profile. Yeah. And maybe 15 years ago, any founder who was looking for seed capital would be a good customer of our capital and our product. And that may not be true today. There may be founders who are, you know, raising a lot of capital for some reason, and they should go to multi-stages. Or maybe they're in a geography where we're not well suited to help them. There may be a lot. So let's build a product which is maybe more like traditional seed stage capital, you know, $1 to $3 million rounds, or $2 to $4, you know, $1 to $4 million rounds, where we're the right product for those founders. That may be first-time founders, that may be more vertical stuff, certainly some AI stuff, but it may be, we call it the weird and the wonderful. It may be a more broad swath of founders, and that's okay. If we don't see everything, I'm past the days of trying to see everything.
Yeah,
I'm sort of the view, we know what a good founder collective portfolio company and a good founder collective founder looks like, and let's look for those and invest in those, and it will be somewhat self-selecting, and knowing who you're good for and who you're not good for, like that's the same thing as when you're being a good operator. Like, who's your customer? Let's focus on your, you know, are you on enterprise? Are you on, you know, consumer? Like, I think all those same rules apply in venture capital. And so anyway, that's the way I've been trying to think about it, is almost like we're operators building a venture capital firm as a business, which is what we are. I just think for many years you didn't have to think of it like a business.
Yes.
And I think that's the big change. But I think some of it also is what you said, which is we've seen these markets. I've been through the .com. I remember the mobile stuff. I remember the crypto stuff very well. This does feel like one of them. History rhymes. It doesn't repeat exactly. So I don't know exactly what it's going to look like. I don't know if we're in the second inning or the seventh. But I know that we're in one of these moments where there is just a lot, I mean, what did Greenspan say? A lot of irrational exuberance.
Yeah.
And we know when that happens, there's some really great things that come out of it and a lot of carnage. Yeah. And I suspect this is going to be no different. I have no idea how it plays out. I have no idea the timescales. But I think you have to at least be cognizant that we're in a moment that feels frothier than, you know, some periods. And so then, of course, the question is how to play it. God only knows, but we're trying our best.
It does beg the question that, you know, there are those founders that at seed stage look at the storied experience that Founder Collective has had, the great companies that you guys have worked with, you know, early days with Uber and PillPack and Verkada, and through the generations.
You're just being nice about saying we're old, but continue.
No,
Yeah.
listen, I'm saying generously. When I got into venture, some of the best writing that I read came from your partners, Eric and David, and occasionally you as well.
A clock is right twice a day. Yes.
But what I say is founders will reach out to you because they see the brand that you have and they want to work with you, and they see the experience and the great things other founders say about you. But then their valuation expectations are AI, Silicon Valley valuation expectations. When you're advising a founder who's looking at, rightly so, AI companies are growing faster than ever. They are, acquiring customers faster than ever. And founders are using those data points in the early days to justify greater valuations than ever. How do you advise a founder that comes to you with those expectations?
Yeah. I think our view is, first of all, like I said before, it depends on the founder, and not all founders are going to get our value proposition. But the way I think about it is ultimately companies are going to be valued on their intrinsic value. Like ultimately, you're going to have to build a good company with real revenue and ultimately profits. And so, yeah, in the short term, if you think you can optimize by raising 10 million on 40 and that helps accelerate you and get you there, I think 9 times out of 10 that is not the case. And I think what I've seen is people actually mortgage in the short term. They take it's almost like leverage. Like they buy the house they can't afford, but because the bank's willing to write the check, you buy the big house.
Yeah.
And then one day you wake up and you're like, oh my God, I have to heat it and cool it and take care of it. And why did I ever buy that freaking house? And I think a lot of that and I think what we can draw on as old or experienced VCs is we've seen this movie. Like I can point them to 10-year-old companies that have a big pref stack or grew really fast in the beginning, but a lot of that was test budget. Like some people are going to, and by the way, more people than you expect nod their head and say, yeah, I have some friends who are founders who talked about that. They raised a lot early and then they hit some stumbles. And we're there, because we try to speak truth and try to be very, we talked a lot about capital efficiency long before it was in vogue. Yes. And I think a lot of people felt like that was like saying, eat your spinach. And I don't care about that. I'm going to go to McDonald's every day anyway. And then I think there were a lot of founders who's like, you guys were right. And while that's sometimes a harder way to build a business, it's probably the right way to build a business. The one thing I always think about, and I try to preach to the founders we work with or prospective founders, you want optionality. The startup game is so hard that if you raise too much too early, you actually cut off options. And the whole name of the game is being able to stay in the game long enough and maintain as many options. And it's counterintuitive because you think more money means more options, but often more money means fewer options because who else is going to fund you after that at that high of a price? And if you stumble a little bit, it's harder to attract talent. So in the short term, it seems easier, but in the long term, it actually gets harder. And so that's what we try to explain to entrepreneurs is like stage your capital, maintain options. Look, Eric and I sold our company for less than $100 million. Like it changed our lives. And yet to a lot of people, those numbers sound like chump change. And I thank God we had the flexibility to do that. There are a lot of founders now who they've raised 100, like they can't sell for sub 100. And by the way, those funds would not, whether or not they'd support it, it wouldn't even move the needle on some of these big funds, $100 million, $200 million exit, but it would change the lives of the founders. So why at the get-go would you eliminate that possibility before you even know?
Can I push back a little bit on that, Micah?
Please, I see you itching.
You see the gears turning a little bit, huh? So I actually don't think that founders today do it for ego or because they can. I actually think the pressure that's happening is large multi-stage funds are in king-make mode.
Yeah.
And we are seeing this more and more where, look, the vibe coding tools have made it easy to make 17 different companies that do the same thing for, HVAC. It's Service Titan for HVAC guys, right?
Yeah.
And there's 18 different software players that are available on that. And all of a sudden you see, name your favorite big multi-billion-dollar fund that is willing to write a $25-30 million check out the gate into a company that you and I would argue over our decade does not have the revenue to justify it, right? But if you are in that category as a founder, you're saying more allows me to compete.
Yeah.
Is that a unfair assessment of what founders
Yeah,
do, right?
I think I agree with you. I think a lot of founders think that. I don't agree with that logic. I think I remember being on the board of Plated back in the early Techstars days, and we were staring at this company called Blue Apron that was raising way more money, and we were like, oh, we were pulling our hair out. I don't have much left. And part of it was like, I was pulling my hair out at that time, like, oh man, like these guys they've got more to market. They can scale up their supply chain, like all this stuff. And in the end, like we exited the company. Look, they took it public, but it, it crashed. And it turned out more capital wasn't necessarily helpful. In many cases, you build actually worse businesses because you can kind of like spend your way out of problems and never fix the problems. I think in the case of take Uber, yes, that is probably the exception where having access to like almost infinite amount of capital can help. Maybe ChatGPT. I think those are rare examples. I think people are indexing on the very isolated few. And by the way, if Uber wasn't working, it would have flamed out. I think it was Uber's access. They had physical offices in cities around the world. They had to get drivers. Like there was a lot of infrastructure, and they figured something out that was world changing.
Yeah.
So yes, in those very few instances, having multi-stage access to a ton of capital. But by the way, if it's working, you're going to have access to all that stuff. And so like the idea that like somehow figuring out early who your sugar daddy is going to be is going to solve the problem. Like, I think that's just like baloney.
Yeah.
And, I think people were looking to Uber and were like, oh yeah, like we got to put capital behind this thing because it's working. The kingmake view comes down to if you believe capital is a weapon, and I do think a lot of entrepreneurs have largely been deluded into the view that capital is a weapon.
Yeah.
I think there are some cases, but fewer than you'd think, where capital is a weapon. I think in most cases, it's neutral to a curse. I may be in the minority in this because I'm talking about the product I sell.
Yeah.
But I think more capital isn't always better, and certainly not at the early stages.
I think from a marketing standpoint, as an industry, we've done a wonderful job over the last decade.
Totally.
Celebrating fundraisers.
That's right.
And, you have said this so eloquently in many of your writing before, but this is such a long game that it takes a really long time to know, is it even working as an investor, right? As a founder, yeah, sure, you've got your KPIs that are probably tracking, but it doesn't give you the dopamine hit that a funding announcement does, or a new investor validating that they believe in the potential of your business does. And so we celebrate that as an industry. And so, looking back and it's the end of 2025, this episode will be out early 26. I can't help but be a little bit like reflective, not just on the past year, but the past decade. What incentives have we set up for founders, and how do we now build businesses as a result of that?
Yeah. We sometimes joke that we're drug dealers. The capital is a drug. And you've seen that, and I'm sure you liked Eric and Dave's better than my post on that, but I'll let you go on this one. I think we've probably done ourselves a little bit of a disservice. I always think about where does it all stem from, and I think some of it is this was a really attractive asset class, and so a lot of capital flooded into the asset class, and it's looking for return. And in the end, we sort of all depress our own returns a little bit by. But yeah, and I just to your point about like companies marketing, now you see companies with graphics when they do a fundraise. Yeah. It's like seed capital, and you see all the logos.
It's like a Coachella poster.
It's like Coachella, yeah. And by the way, the quality has gone up and up and up. Some do videos. It's all well intentioned. It's like good marketing of like. And by the way, a lot of it, and what founders will tell you and us and me is like it helps with recruiting, right? Like if I can show, and ironically, when people, at least historically, would say, should we announce our round? I was like, don't announce your round. Like, nobody really cares. You raised $4 million. Like, in the scheme of the world, like, that is not newsworthy. And most disagree. Most are like, in order to recruit, I need to scream from the hilltops. And so maybe my advice is dated. And maybe in the super competitive world, again, I come back to, like, are you attracting the right people? And, like, but yes, I think we have definitely gotten to the point where we're celebrating those rounds, and like that is like a milestone that people talk a lot about. I mean, you never even heard about valuations in the press, and now it's like quite literally every story of a big round, they talk about the valuation. They name everything.
Our sort of ethos at VSC, where we work with PR and marketing with our founders, we have our friends in the press who say, do not send me a funding round unless they're willing to talk about valuation or revenue. right? If they're willing to say how much ARR they have, great. We'll be happy to talk about it. But if you just show up and say, I'd like to announce my $10 million round, please get in line.
So what do you tell them to do? Like, given that they want to make a story out of it.
This is my perspective on the founders I want to work with, and this has been, I think, tested now over a couple of funds. Right when I was at Launch Capital and now building my own fund, I want to back founders that want to be the mascot for a particular industry or category. I've used this analogy before, but somebody who I think does a great job of this is Ryan Peterson from Flexport. If a ship gets stuck somewhere on this beautiful globe, he's talking about it, right? And it's not somebody at Maersk or MSC.
Right.
It's this startup called Flexport that wants to be talked about it.
Right.
I want to back a founder that recognizes that is the opportunity they have. There's an industry that doesn't have a mascot right now, and they can be that. So that can be press, that can be Twitter and LinkedIn. That can just be showing up at the events where the people who you want to recruit are. But from a press and PR standpoint, Michael, like it really does move the needle when your CEO is out there talking about what you're doing and is being a chief evangelist. And as we sit here today, and it's easier than ever to start a company and harder than ever to break out, you need the people doing the things that don't scale to help you break out.
And by the way, you make me think a couple of portfolio companies like Emporia or Iris Software, where the founders are the go-tos in their industry. The first one's market research. Yes. The second one's like consumer goods. And they, one talks about tools, the other does a breakdown of, exits and public, reports and like financials, and like just having that, like your own channel, your own voice, that's really valuable. But that's very distinct from just saying like, hey, I raised a lot of money at a price or whatever.
100%.
I look for founders that are able to like have their own channel, tell their own stories. Like, to your point, a lot of this is can you rise above the noise? And I think good founders are able to tell a story. Not that, and this is the point. The capital isn't what allows you to do it. Being a good storyteller does. Like I think back to when Eric and I ran a business in the dental category. We knew nothing about dental. Eric said I'd missed the last 2 years of dental appointments. Like we knew nothing about the field, but when we got into the industry, we learned we could tell the story about the future being digital. We talked about how, the old goops and paste and plaster of Paris. We had a slide that showed the Egyptian pyramids. We were like, the tech hasn't changed since the Bible. Like, that's how long it's been, like we're disrupting like thousands of years old. Like the fact that we're still making plaster molds of people's teeth is ridiculous in, 2000, whatever, when we were doing the company. And I think that was the value, like telling that narrative. And the capital, it gave us the resource. It was like gas in the tank. But instead of like celebrating the gas in the tank, we celebrated where we were going. We're building the future of this thing, and it's, digitizing this age-old industry. That's the power of startups and great entrepreneurs.
How much does founder market fit matter now in this age of AI? I sort of feel like AI is this great equalizer where everybody can get 80% good on an industry with a couple of deep research runs. It's the last 20% that I'm often testing for in diligence conversations. How much do you guys weight that when you meet a founder versus other things that matter more?
I mean, I'd be curious what you think. I think this is the challenge right now. And this is where, really dating myself, but I do feel like the .com analogy holds, which is I think a lot of entrepreneurs, myself back in those times, thought the insight was the internet.
Right.
But what I wasn't fully grokking was that everybody saw the same insight. Everybody saw that things were going to go to .com. Like, it wasn't such a unique insight, but I was like, aha, Amazon's selling that online, so we've got to do, we were doing house cleaners and carpet cleaning, auto repair and that kind of stuff. I think the challenge with AI is, like you said, it's an equalizer, but everybody has access to it. So that isn't 80%. You're, that, and by the way, there's a whole debate which we could have, but like, are the incumbents or the early stage more advantaged? It's very different back in the .com days because Amazon was fighting against Barnes and Noble. Barnes and Noble was like structurally unable. They had stores everywhere and mall. They were, for them to migrate to an online store. Like, first of all, it was a totally different DNA. What are they going to do with all their physical stores?
The innovator's dilemma is very real.
The innovators, I'm not sure the innovator's dilemma is real this time. When you're talking about, Google, like all of a sudden Gemini looks pretty damn good. The latest release, a lot of people are saying they're not using ChatGPT as much and they've moved to Gemini 3. So I don't think the incumbents are so sleepy this time. And you're competing against tech companies with tech. So, and tech is much more pervasive in the economy. So I don't know the answer, but what I do know is you need some real novel insights. So that may be founder business fit. That may be some non-obvious insights about, Uber is the perfect example of like things were migrating to the mobile device, and people were like, well, let's build the web apps on mobile. But really the insight was there's this GPS chip in the phone, and it tracks you wherever you go. And by the way, the drivers can now match. Remember, there used to be a dispatcher. You dial 7777. That was the whole thing. And then someone had to be like, "Where's the car?" and then call you back. And then all of a sudden, we had these devices. Like people forget, like that was a massive siege. That was the inflection point that allowed Uber. Mike Maples, who has a great book about this, talks a lot about pattern breakers. He talks a lot about this stuff. Talks about how Facebook Connect allowed Airbnb. It's these non-obvious insights that I think really changed these markets. And so I would say the last thing we're doing, which we've always done, but I'd say more than ever, is look outside of the echo chamber and what we've always called the weird and wonderful. We've done a bit more hardware than usual. We've done some stuff in healthcare. I would say even some special situations that aren't your classic seed, like spin out situations, just things that don't look like central casting, because I think right now those things are so bid up and so frothy that we don't see as much alpha there as we do.
There's an innovator's dilemma in venture too, right? It's like that's not stuff that our friends at Sequoia or Benchmark or GC are going to look at because they're writing $50 million slugs.
That's right.
Now, I say that knowing that they also have their seed funds, and so that's a different story. But I think from a core standpoint, right, you have to kind of position yourself where maybe other folks are not willing to or for whatever reason haven't gone. I'll give you an example from my portfolio. We have 3 investments in public safety. Not something I had on the bingo board when I launched this fund.
By the way, I think we have a couple as well.
Yeah.
So
and it's a space where I have, used to have to evangelize to the next round investor. And I think in the last year with, Flock Safety and Peregrine and Axon making a bunch of acquisitions, I no longer have to evangelize. And in fact, my companies are seeing inbound interest themselves and get to have their pick of term sheets, right? Yeah. I find myself often looking at spaces that are almost at that point where, the investor interest might get there. The companies are clearly finding, a wedge with customers. Where I have gotten caught before is doing that a little too early. Yeah. And I'm curious how you think about that, where it's like, I love coming in early. I love coming with conviction. And then when it's too early, we're in a position of like, nobody wants to fund this thing, even though it's working.
Well, and in some ways, like I always go back to, I say this a lot on a lot of things, so it's a favorite quip of mine, but like most things are priced in. So there's some, right? Like it's not just market inefficiency. The markets in general, particularly liquid, markets that are moving quickly, are pretty efficient. Yeah. And I think in the venture market, so it's sort of like, what risks do I want to take? Yeah. And I think in a lot of these weird and wonderful special situations, you're taking financing risk. And you're clearly better at this, because I think a lot of those we do struggle to follow on. Often the insiders are doing a note, and I think they're good companies, but they're not in the zeitgeist. I'm willing to take that. I'm generally willing to take that risk because my view is at some point, like we saw this with CPG, like at some point either they're going to build really good businesses and or someone will come on to finance them. Yeah. CPG has been out of favor for like a long
7-8 years, basically since like Facebook and Instagram ads got figured out.
Totally.
Right? So there's like 19, 20, 20. Yeah, maybe. Yeah.
So, and I think I read about this the other day, but we did this analysis and we were like, we have maybe 10 CPG companies over the 250 plus companies we've done over 15 years. And, between all of them, they're closing in on $1 billion in revenue, somewhere between 500 million and $1 billion. Most of them are profitable. Yeah. It was kind of like we went to sleep, we woke up, and these companies that we were super worried about that couldn't raise money figured it out. A lot of them figured out physical distribution. They got into Target and Costco. Some of it just figured out how to like lower their CAC. Like they built actually pretty good businesses. Yeah. They're not going to trade at 20 times or 200 times revenue. That's okay. But they also haven't raised crazy amounts of money. Most of them haven't raised crazy amounts of money. So the point being, I think if you're willing to accept a certain set of risks, you can go, financing risk being the big one, you can do these weird and wonderful off-piste opportunities. And by the way, many, we were joking, we don't have any theses. We're a generalist firm by design. Yeah. And then we've done 4 businesses that touch HVAC in the last year and a half. We're like, what the hell? We have an HVAC thesis. We didn't even know it. Yeah. And I think the reality is like, then you wake up one day and you realize, like, actually these categories do, that's what happened with Uber. Like, years later, Wired magazine issued this thing that said transportation tech is the, all the rage. And we're like, really? You're like 7 years too late on that one, guys. But I think that's what happens a lot too. And my suspicion, I don't know if there's going to be HVAC, like it's.
Oh, there is. I think people are branding these categories as, labor tech or
totally,
defense tech. And yeah, defense tech's been around, but these categories get named. I'm more, I think, struggling is sort of not the right word, but like trying to find the right point of view with these Series A investors who often tell me, hey, this company looks great. They went from 0 to 3 million in 18 months. That should be celebrated. I'm looking at a company that did 0 to 10 million in 6 months, right?
Right.
And so what I often find myself, either saying is, hey, am I talking to the right subset of investors?
Yeah.
I know you have a point of view on this too, where both your, downstream and upstream friends have to continually be refreshed. How do you make sure your network, both upstream and downstream, stays aligned with the way you invest?
Yeah, that's one of the hardest parts. And we did this analysis, which I've also talked about, that every given year in the most recent years, we've basically 50% of the lead sources that we've had are new. That it's the first time they've sent us an opportunity, which means you basically have to rebuild half your network every year. And that's why I think this business, it's why a lot of people are doing a lot of sales and marketing and podcasts and writing and out and about at all these parties. And even though I'm somewhat introverted, I have to go to the cocktail party and schmooze a little bit. It's an increasingly important part of the business. I think likewise for, I forget downstream and upstream, which direction is which, but for the Series A,
downstream being who's marking up your deals and upstream being whose deals you're marking.
We are spending more time with the new funds.
Okay.
Because I think our view is they're hungry, they've got a lot to prove, they'll value our signal, and may be willing to take more risk. It depends, right? Some new funds, to your point, want markups because incentives are everything and they need to fundraise.
Yep.
But I think we've got our people we historically collaborate with, but most people have gotten bigger.
Yeah.
So we're having to refresh our Series A and B network quite a bit. I also think it's like just so. I'd be curious if you would agree to this. I think the cap tables all look so different now. Like, it used to be like, I don't know, you'd see the same names 1 out of every 3 times. You're like, oh yeah, there's that fund and that person and that. And now it's just like, I don't know half the names on the cap table. Not even talking about the individual names. Like, I don't know some of these institutions. And so I think A, you need just a big network, and B, these founders are working it. I get spreadsheets with hundreds of names, and if you asked me to predict who's going to do a Series A or B for a given company, I have no idea.
I think the hardest part of it as a smaller, up and coming, spin out is probably not the right word for what I did at a Launch Capital, but started a new fund. There are so many folks that we can co-invest with. I am a little bit more, I think, willing to chance that with somebody new, but I first want to get to know that co-investor a little bit more.
Yeah.
The times that I have gotten burned is when a co-investor I don't know their structure, don't know their incentives, their partnership, how aligned they are, is leading a deal. And they bring us in because they say, hey, you've got this expertise in marketing and storytelling, and we want that on the cap table, and the founder seems to love you, and let's make room for it. And then you realize, oh, this was a option bet for them, or this was a exploratory check. It's, they're really more of a infrastructure security investor. They're doing something at the application layer for consumers because they were curious, or, it was a buddies deal or something like that. And that's where I've gotten burned. And I think whereas folks who, I think I've known their work for a while.
Yeah.
I reference my co-investors the way I tell my founders to reference the investors on their cap table, where I'll reach out and say, hey, what founders have you worked with in the past? And, can kind of cold reference them and say, hey, do you like working with this investor? I've done that with Founder Collective, by the way, and I've gotten some really, really great reviews, which is why you're on this couch.
Thank God. For a second there, I thought you were...
No, Todd Saunders is a good friend, right? And I've known Todd from the Texters days. And Todd,
and if you're not following him on LinkedIn, by the way, he's writing great stuff. He's one of my favorite.
He is becoming a mascot for he
for
was
a lot of stuff we're talking about here.
Yeah.
Hey Todd.
And hey Todd.
I hope you're listening.
And so I say that as an example to say, like, founders are willing to be honest if you have a relationship with them about which investors are like working with. But that has absolutely become a harder part of this, where somebody sends me a deal And I often ask myself, why are you sending me this deal?
Yeah. By the way, I think I've come to the view over many years, I don't put a lot of value into the signal from someone sharing. It's not to say it's zero, but I think I've been burned by believing this multi-stage is so, like, I got to look at every opportunity with fresh eyes, independent of who's sending it. There's so many different incentives. Who knows? Like, I got to decide, is this the right deal, opportunity for us?
Yeah.
Independent of, look, I think it's additive if you have like someone who's leading, who's a great partner for a given thing, but that's not a reason to make an investment. Likewise, if someone's pounding the table, like, they just may have different taste. They may, there's just so many different games being played out there that I think I've got to look at everything. And honestly, I mean, it's kind of funny, but in this market, assume everything's getting funded eventually at the early stage. Credible opportunities are going to get funded. So then if we start from that baseline, the real question is, are we the right partner, independent of who else is around the table?
Yeah. You talk about this idea of waiting for the second wave.
Yes.
I'd love for you to explain the distinction between the first wave and the second wave, and then we can talk a little bit about where we are in the waves with AI.
Well, I'm a very bad surfer, so I usually catch the smaller wave. Maybe it's true in investing. Hope not, but we'll see in the next 400 years. Yeah, I mean, I think we, just like in the .com, where some great companies came out, I think about Amazon and some of the great companies that came out of that wave, Google, maybe a little bit, these timescales are longer, Facebook, but I think we're going to see the same thing here. I do think there's going to be a fair bit of carnage in this first cycle. And I think people are talking about that. I don't think that's like a big surprising notion, but I think just like you're seeing with crypto, where all of a sudden people weren't paying as much attention. And, I'm lucky to work with two partners, who are from South Africa originally and have a more global view. And they're like, by the way, people are using crypto to stable coins to buy things. And they really view it as a currency. And like, you're like, again, while we were sleeping a little bit and paying attention to something else, all of a sudden real use cases. And, we're in a company called Talos Trading, which is growing. And, Coinbase has been growing. And like, the ecosystem is growing, and yet no one's talking about it anymore. Yeah. But when everybody was talking about it, it was so frothy, and everyone was doing ICOs and buying Bored Apes and all that craziness. But it turns out maybe the moment is like now to be making these investments, because the use cases and the adoption. And by the way, crypto being down, maybe even all the more reason like to do it right now. But that's kind of what I mean about, like, you just need the patience. This really is a slow game in some ways. Yeah. Both at the micro level, a single company, but like this idea that the world's just going to change overnight. I know I'm a VC and I should be like, oh man, like, we're all going to be in driverless cars tomorrow. But like, think about how long that has taken to evolve.
Yeah.
Eric used to say to me, Zoe, his older daughter, is not going to need to get a driver's license because by the time she's of age, autonomous cars are going to be everywhere.
Right.
She has her driver's license. She drives all over the place. So like, and my son's getting his driver's license too. So like, I remember when we did Cruise, you were like, oh man, this is the future. And I think that was 10 years ago.
Yeah.
And they got bought by GM. It just seemed around the corner. And yet it's taken a long time.
If you don't want me to ask you, how do you have this conversation with LPs when all of these venture funds are effectively going after a lot of the same dollars? The venture fundraising market has gotten bigger as an asset class. I think there's been more interest in it. But the types of players that understand the long game that venture is, I think has become a smaller percentage of that bigger pie. You guys are one of the most disciplined seed funds out there. How do you have that conversation with LPs where you say, listen, we know you've got maybe other funds in your portfolio that are chasing after these 0 to 100 companies. We like the methodical approach that we play.
I mean, it's kind of a little bit like the founder business fit, or I think it's the right product for the right LPs. I think people who have come to know us, they hear the story and they sort of nod their heads. And we're, in some ways, while I think we are practicing something very different than most of the industry, I think we're also practicing the craft as it always has been, which is a real, not necessarily discipline, but a real focus on the founder, go deep, not spray and pray, not multi-stage. It's sort of venture as it used to be, a craft. And So I think that for LP, and we're small. So for most of our LPs, we are a small window into the future. We're a small check with an amazing group of founders and kind of viewed as high volatility. And hopefully we can deliver outsized returns by staying small. And I believe we can. But that's not for everybody. I mean, it's certainly these massive endowments that are trying to move. The ironic thing is we used to hear things like, "We love your strategy. Can you take $100 million check?" And we're like, no, the whole fund isn't even that big. Or they'd say, "We love how you're small. How about a big check?" And you're like, you're talking on both sides of your mouth. And like, so it just doesn't work for a lot of LPs because we are small.
Yeah.
But I think for the right ones, we are what venture was meant to be, which is a window into the future, high volatility. Early, like by definition, we're getting in at the lowest prices. And I like to believe people leave our annual meeting feeling like, wow, this is different. Like, this is really venture at the seed stage. The way I think the way we talk about it is the way a lot of our LPs will believe venture should be practiced.
Right. Well, the word seed has also become bastardized, right? I think that's the other challenge too of I think about specialization a lot. We are also largely generalists, but I think I go down rabbit holes, and so I should find a better word for it. I say, thesis driven. Like I have spent the last
rabbit hole ventures just doesn't
ring as well, right? But I spent the last 2.5 years obsessed with labor shortages. We are not a labor shortage fund. If somebody comes across with a different thing, I'm more than happy to kind of go deep with them on it. But we have found some weird and wonderful things in this topic of labor shortages, right? When I have conversations with LPs, I tend to find that people want to put you in buckets.
Yeah.
And as the word seed gets changed around, as everybody's looking at verticals in AI right now, how do you think about the bucket you want to be in as compared to maybe where the rest of the industry?
I think it is a challenge now. I think it's the same challenge entrepreneurs have choosing venture firms. I think it going back to like why we do a lot of this stuff and why we're in our latest annual meeting we said we had a big slide that says not VC FC. And so like we continuously, and thanks to Jess and Joe on our team, are constantly trying to like tell our story in a way that really speaks to the capital efficiency, the weird and wonderful, that we talk about our network is our net worth. Like we have a point of view. We're all operators. Yeah. So the first thing you learn in operating is like, have your mission statement, tell it at the all hands every Monday. Like we kind of do that stuff. I mean, we don't say it every Monday, but like we every annual meeting has the same first slide. Like we really try to stick on our message and our point of view. And I think over time people are like, wow, they really mean what they say. Because I think that's how, I mean, you know more of this than me. I'm not a natural marketer, but like some of marketing is tying your actions to your messaging. And so that it like all the way through it becomes believable. It's like, okay, these guys, they talk about weird and wonderful, and a lot of their investments do look kind of weird, and they talk, and they really say what they mean. And because so many people are like founder friendly, and then they behave very differently. And I think it, up and down from how you interact to founders to how you talk in podcasts and blog posts to how you interact with each other, everything's got to line up to the same mission statement. We've tried. We're not perfect. We've certainly made mistakes on this front, but try to live those values that we espouse, and I think that does get back to LPs, is my sense, where people are like, wow, those guys really, they say that stuff and they actually practice it. I think it's the product of decades or years and years of doing that.
Yeah, I do find that like being referenceable by founders is probably the most valuable thing.
Yeah.
And again, in sort of my young life as a fund manager, but even going back to when I was just an investor at another fund, the fact that I now have these founders where like I have a high degree of confidence that somebody can cold reference and I kind of know what they're going to say. That ends up being the strongest thing. And that is where I have kind of found my way into deals where it was a competitive round, but the founder picked up the phone and did some references. That is the one thing is sort of like my bully pulpit where I'm just like, guys, before you sign the term sheet, just make a few calls, call some people, get the good.
Do do most of these founders, or do they just want to get the money and they
I think I would say the vast majority are so tired by the end of a fundraise. They've gone through, even if they've done it well, and they've kind of compressed it into a 5-week sprint, which is, I think, the best.
It's like, I just want to get married. I know I should probably figure out if the spouse is right for me.
Yeah.
But I just so badly want to get married, so let's just get married.
Maybe I should meet the rest of the family.
Yeah.
To get to know.
I just don't have time.
And
really want to get on the honeymoon.
Time and time again, what happens is sometimes that person leaves the partnership, or they were never a partner. They were maybe a junior.
Happens
partner,
a lot now. Yeah, more than ever.
They spin out and start something new, and you just have these orphan cap tables.
Right.
And it is such a frustrating thing as a co-investor on those deals to then say, okay, we kind of pick up and figure out how to put your life together again. And so it's one of those things of like, when capital is so abundant, I think discipline goes out the window. It's why I respect you and Mike Maples, and I think there's a handful of firms that have really influenced my thinking through the writing and the investments they've done. Is discipline is the most radical act in a time like this.
Totally.
And I think it only gets harder as mega funds raise bigger and bigger rounds, and seed can be anything from 2 on 12 to whatever Mira Murati raised, $2 billion on 12 billion. Right?
And you start questioning your own judgment. I think in these moments you're like, am I the fool? Like, everybody else seems to be raising at the and I think you have to really believe in what you're doing, because I mean that is sort of the definition of investing, which is the non-obvious, the being contrarian. I think Maple says it, being contrarian and right, and I think that's hard to do, particularly in these sort of bull markets. To your point about referencing, I was talking to my partner Amanda in the office the other day, and she was saying she was trying to win an opportunity to invest in these founders, and they put the founder on the phone with one of our other founders, Josh. And Josh apparently said great things, and the founder said, "You should put all your founders on the phone." Like, he was amazing, and I was like, "Amanda, it's a testament to you. Like that's what you want to happen." And I wonder how often that either the founders don't do it or the reviews wouldn't be so great. I mean, the things I always say is like, call the ones that didn't work out. That's that's what the LPs should be doing. I hope we're doing. Like, let me call the founders where things didn't work out. Yeah. But how many actually do that? Certainly, how many founders do that?
Well, call the off book ones, right? If they send you 5, call the ones that didn't, because why'd they send you those 5?
By the way, I've learned too that, I don't know if you've seen this, but I actually learn a lot about founders on how they run their process.
100%.
Like, I almost learn more from that than the pitch itself.
Yeah.
And I'm like, if they're smart enough to call lots of founders, I'm like, holy crap! Imagine what they're doing when they recruit. Imagine what they do when they're like, they're just all over it. And like, you kind of want people like that.
Yeah.
And when people are flip, you're like, oh, well, there may be flip about everything. That's not good.
My philosophy is, as a CEO, you've got 3 jobs: set the vision, hire the people, make sure there's enough money to keep doing steps 1 and 2.
Right.
And each of those things is a place where you can really shine through. If you can be a great fundraiser, you can paper over some of the other things.
Totally.
If you can be great at convincing people that probably could make 3 times as much going over to Meta because Zuck's willing to write the check, but they come work with you, okay, there's clearly something special. And then the vision piece is really where I think the marketing and storytelling gets involved, because you're selling something to a customer that isn't quite there yet, but you're selling them on the promise of, hey, work with us and we'll get there pretty quickly.
Yeah.
Everything else I find as a CEO, at least the successful ones in my portfolio, they're doing until they can hand it off to somebody else.
Yeah.
And then they really kind of focus in on that core. So you're right. I think how you run a fundraise process is in the core competency, should be in the core competency of the CEO.
I mean, I always think about, like, and I've learned this the hard way, but like, the details matter. Mm-hmm. And, sometimes these founder will like, our term sheets are really vanilla, but like, they'll be scrutinizing ours, or there'll be a round will come together and they're, wordsmithing these terms. And I'm like, while it may take extra cycles and a little extra capital, I'm like glad they're like, they're looking at this stuff and they're thinking about the implications, and they're, I really think that, like, the job of a founder is also like to go deep on a lot of things, at least at the early stage. Elon, whether you love him or hate him, like, he's thought of as a total micromanager. I think in many ways, a lot of great entrepreneurs are. They're just able to go, they can go broad and they can go deep. Yeah. And you kind of see that during I often think about that in the second meeting of a pitch.
Okay.
Like, if the first meeting I get excited, but that's That's the kind of like the coming attraction to the movie. You know, it's 30, 45 minutes. It's the first time I've heard the story, and if I'm excited, you know, I usually kind of know within 70, 80% after that first meeting. But the second meeting is really the critical one, where I feel like, oh man, like this founder has like peeled the onion 5 different ways, and like I can probe in different areas, and there's just like a depth of understanding and insights that it's the same thing. It's just like they're willing to go deep, and like they've really there's few people on the planet who've gone deep on this given space. So I don't, you know, non sequitur, but I love that second meeting. That is really indicative to me of like, is this founder all over it?
Yeah.
And when
I love that piece of it. I'll ask another one. We talked at the beginning of our conversation, maybe, you know, before we hopped on the mic, like, are all the old playbooks dead, right? We've had conversations on this show where a lot of investors have said, you know, since ChatGPT moment, we've rethought how fast a company can go, what a structure looks like, what the first 10 hires have to be. I'm curious, when you are both, you know, in the kind of pitch with a company, but also post-investment, you're on their board, which playbooks have you thrown out?
Yeah. I think AI is really augmenting our playbooks. I mean, maybe this is a, you know, dodge the question. But I don't think, I think like tales of my death are overstated, you know. I think how it's going to augment, or how it's starting to augment, I think it helps a lot with diligence, writing memos. And like, I think there's no question you can, and I think training, I think we're seeing how AI can help train our new staff, because it can learn so much about us. We can ingest lots of data, ramp up folks, you know, note taking and all that stuff. I think outbounding is a big change in the industry. I think AI has also augmented that. I think that was starting before the AI thing. We never outbounded really.
Yeah.
Now I would say, I don't know what percent of the industry, but a meaningful double-digit percent, probably more than half, but is doing some amount of outbound.
Agentic SDRs.
Agentic SDR. But you would never have thought this industry would be cold emailing, the boiler rooms dialing for dollars. But to hear the ventures doing that. But I think while we're dabbling in all those things, those are extensions of the same. I don't think the core business has changed that much. Mm-hmm. Look, do I think in 5 to 10 years, as I've said, every 3 to 5 years, the business changes a lot. It could change. I mean, the Bordy Boardman is hysterical. And so I tweeted to Andrew, I don't know if you saw this, I said, Bordy Boardman should raise his own fund. And then the next day, he's like, he raised his own fund. And he's like, it was like, Bordy's on his own. I don't even know what Bordy's doing. Like, he's out at parties, he's raising funds. Like, you know, he's having a good old time. And that's all AI. I mean, it's freaking crazy. And like, would it surprise me if like this sort of agentic investor starts to exist in the next, you know, couple of years, like Bordy? No, I mean, I think, but does that also mean that like we're out of business? No, I don't think so. And maybe this is sort of like the autonomous cars thing, where, you know, you have Teslas that are like, I don't know, level 4. I always forget which levels. And you've got, you know, the Waymos, and then you've still got, you know, you got electric cars, and you still have, like, I still have a, dare I say, you know, internal combustion engine car, like, you know, just an old regular car. And so like, maybe there's just different flavors of the model will continue. Do I think like the rule book is dead? And I don't know. I feel like there's a famous last words, like this time is different. And like, yes, things change a lot, but not, I don't know. If that means like price doesn't matter, you know, capital is infinite, you know, everyone's going to be successful and we're all going to live on Mars. Like I that's a little further off than.
I would tend to agree with that. I mean, I think where we have reset some of our expectations is on what the founders should be able to do with this first round of capital, right?
Yeah.
To me, like I find myself asking, you know, 2 questions a lot, and I used AI to test this. I actually dumped a bunch of calls from the last 3 months into AI, and I said, what questions am I asking over and over that I'm maybe not even realizing? And AI pointed out to me that I care a lot about time to value. That is one of the first questions I ask with a founder as we get to the kind of that like product phase of the conversation or the customer phase of the conversation. How quickly is the customer realizing this value? And when I looked at the companies that I've actually invested in, that ended up being one of the things that I wrote in my deal memos. And I said, this is a, you know, industry that typically shows time to value in 90 days. These folks show it inside of 2 weeks, right? That's a big change.
And was AI like flagging that for you valuable to hear Like,
I didn't realize
Yeah.
how much of a waiting. I mean, obviously, I knew I cared.
Yeah,
about it.
yeah.
I'm the one asking the questions.
Yeah.
But I didn't realize how much I cared about it or how often it came up.
yeah,
So I kind of got percentage scores. It was like, hey,
Yeah.
in the, let's say, whatever the N was, might have been 80 calls.
Yeah.
Across these 80 calls, 60% of them, you end
Yeah.
up asking about something around sales cycle and time to value. Okay, you clearly care about these
Yeah.
things. But my point is, my expectation for time to value has gone shorter.
Right.
I expect these founders to be able to build products that show time to value sooner, because I think actually just culturally with the GPT moment, people have become more impatient.
Yeah.
And I think these industries, these dirty, dusty, and dangerous, these weird and wonderful industries that I love too, may have skipped SaaS, but
Yeah.
they all now use GPT for random
Totally.
things from copywriting to, checking
Yeah.
invoices. Their expectation of value and how much value they can get has gone up,
Yeah.
and the time expectation has gone down. And so to me, I think the one playbook I've thrown out is like, oh, okay, if you're able to show value in the first 30 days, that's wonderful. I think 30 days is too long.
Yeah. Yeah, I don't know. It's an interesting, maybe rename TTV Ventures or something.
Yeah.
I
I love you renaming my fund.
Yeah, I keep reading. I don't know. It's easier to do if someone
fair
else's
enough.
fund. I don't know. I think that's for some segment of companies that's probably right. I mean, I think back to Eric and my company. Like, took 2 years to even figure out if the damn thing was going to work. And I remember, I felt like I was in a black hole. Didn't know where the light was. That's a tough place to be.
Yeah.
On the other hand, like, I do think that is how you create value. Like, that's how you create moats. And so if everybody in 30 days can start generate, and I know you're talking more from the customer standpoint,
Yes.
less so from the venture standpoint, but I do think, yes, I think just like you see, they used to talk about all these countries that skipped, the landline and went to mobile. I do think AI has a little bit of that where it's like, yeah, I never built a really fancy website, but now I can buy, I do think there's a leapfrogging going on, but I don't know. I think you can over-index on that too. I still think really hard, real value is sometimes harder to implement and takes longer. But in general, I do agree with you. I think enterprise software took a long time to onboard, and it was a lot of migration, and often you had servers in the place. And then, and then there was a SaaS thing or ASP, it got renamed a whole bunch of times, but like Salesforce was the first. And it's like, oh my God, it's in the cloud, and like I can add fields. And so like AI may be the next one where it's like, oh, I don't need software. By the way, it's kind of like Benioff saying, Benioff used to wear this thing that said no software. Right. That was the whole thing about SaaS. Well, maybe AI really is the realization of that. You don't even need software. You could just be like, everything's a chat client. CRM's a chat client. Everything just exists, and like, hey, which customers should I follow? Oh, just follow up with them. You don't even need. I look at some of the companies I'm even evaluating now, and it still takes time. There's still like, I don't think it's flipping a switch. I think there's still like, if you're trying to sell an enterprise, there's still an integration and adoption. Like with all the AI in the world, you're still dealing with humans and data and legacy systems. And I think if anything, I'm learning it's not so much easier than I thought it would be. Like,
okay. That's a contrarian.
Yeah, that like, change management is still really hard.
Yeah.
And I think about some of our companies that are like co-pilots in vertical industries. And you're like, oh man, you could sell more and be more efficient. Like, why aren't all the reps using it? And you're like, well, some reps are, they like to do the way they do it, or, so I don't know. I think the pace is accelerating. It's just, I still think adoption and TTV is hard.
It's accelerating in different industries at different paces.
Totally.
I think that's sort of the right piece of it. And you've written about survivorship bias being one of the biggest crimes we commit in venture. I think there's a fair bit of that here too, right? Everybody sees legal previously as being an unfundable category in the SaaS era,
right.
And now how many legal unicorns have been minted while we've been having this conversation?
Yeah. For a lot of these guys, we host an event in Boston, and we had a bunch of CEOs, CTOs from prominent, even public tech companies, and one of the guys said, I think we have a dozen AI coding tools that we're testing, and I'd be surprised if we kept one, more than one.
Yeah.
And so you're like, oh, I'm like, dear God, I hope these aren't our companies that he's talking about. But, I think there's a lot of like that kind of revenue. And so, yeah, you might show early revenue, but not necessarily sticky revenue. So I think you have to really unpack that, and it's hard to know at the early stage.
Yeah. Well, this has been such a weird and wonderful conversation.
Oh,
I'd
thanks.
love to maybe close looking ahead a little bit.
Yeah.
If we look 5 years out, what do you think is a largely consensus view about seed investing today that you think is going to be totally wrong?
I think one of the things people, I think there's a view that like the bigger are just going to get bigger, and it's going to look like Blackstone and KKR, and there might be some small funds like ours, but like it's totally going to consolidate in the. And and there's going to be a lot of death and destruction of venture firms. Like they're going to go away.
Yeah.
And being old enough now to live through a few, I just haven't seen that happen. Maybe this time's different, but I think VCs are extraordinarily resilient. Their capital does seem to always find its way. Maybe some of these funds shrink a little bit, but I think the industry will look less different in the next 5 years than people think it will look. Mm-hmm. And so I think there will still, yes, there will be some barbell, and yes, the big funds will stay big, but I don't know if the industry is like going to look like private equity or hedge funds. I think we're a unique animal, and I think we're going to stay that way.
For my sake, I certainly hope so.
Yeah, you and me both.
Go out to raise our next fund next year.
Micah, that's what the dinosaur said too, right?
Exactly.
Like,
right
we're going to be around forever. This place is great.
The asteroid hit. Yeah. Famous last words. Micah Rosenbloom, this has been so fun. Thank you so much for
Great to see you, Jack.
Climb.